How many of us were taught about investing in school? Most of us learn science, history, math, and even practical skills like budgeting or cooking in school. But one of the most important life lessons is often missing: how to save and invest money from a young age. Peter Lynch, in his book Learn to Earn, makes this point very clear. And while he was talking about schools in America, this is just as true for us here in India. Most of us learned about money management only after we started earning, often missing out on years of potential growth. This lack of financial education can hold us back from achieving true financial independence. Are we literate? Absolutely, yes. But if I ask you, are we financially literate? That's a different story, and most of us would hesitate. In India, where financial literacy is still growing, it's important to learn how to make our money work for us. Saving in a bank account is only the beginning. Investing, whether in stocks, mutual funds, or businesses, is how we can truly build wealth over time. The earlier we start, the better. And that's exactly why we are here today. Peter Lynch is one of the most successful investors of all time. He managed the Fidelity Magellan Fund, growing it from $18 million to over $14 billion in just 13 years. His philosophy: investing isn't just for professionals, anyone can do it, with the right knowledge. Whether you are new to the stock market or just curious, this book is the perfect starting point. This book is famous for its simple explanations of investing and stock market basics. It is considered the best book for beginners and anyone interested in learning how to invest. If we take Lynch's lessons seriously, we can secure our financial future. So, let's dive in and learn how to take control of our financial future, starting today. About 400 years ago, life was very different. Most people worked on farms owned by landlords, zamindars, and barely made enough to survive. These landlords controlled everything, so opportunities were scarce, and people stayed poor. There was little chance to make extra money or improve their lives. First, let's talk about capitalism. Without capitalism, the stock market would barely exist. But what is capitalism? It's an economic system where private individuals or companies own businesses, not the government. In capitalism, products, prices, and how goods are distributed are controlled by competition in a free market. Capitalism changed everything. Suddenly, people could earn money in new ways, start businesses, open shops, or work in factories. If someone had a good idea and a little money, they could turn that idea into a business. One big reason this change happened was thanks to Dutch merchants. These traders gathered resources from their country and traveled the seas to do business in other lands. India, back then, was one of the world's biggest markets. These traders eventually created the Dutch East India Company, and through trading, not just the rich, like kings and landlords, but also regular people became wealthier. Capitalism opened the doors for everyone to participate in business and grow their wealth. Now, let's think about our lives today. We wake up to the sound of an iPhone alarm, brush our teeth with Colgate toothpaste, take a bath with Lifebuoy soap, wear Levi's jeans and a Raymond's t-shirt, grab a coffee from Cafe Coffee Day, and drive to work in a Tata car. These are brands from all over the world, and they're part of our daily lives. Peter Lynch, a famous investor, says that if we use these brands every day, why not learn more about the companies behind them and invest in them? It's easier than ever to do that now. As you use these products daily, you know them very well. The stock market is a place where it doesn't matter if you are a man or a woman, or how much education you have, anyone can invest. If you are using these products, why not take the next step and invest in their success? You don't have to be a financial expert. Just start with companies you know and trust. Investing strategy 1. Start early. Investing is one of the best ways to achieve both democracy and equality in money matters. And guess what? The sooner you start, the better. That's why the first rule of investing is, start investing as early as possible. Time is your best friend when it comes to growing your money. According to Peter Lynch, to be a smart investor, you need to beat inflation. In India, inflation is around 6%. So, if something costs 100 rupee today, it will cost 106 rupees next year. You need to grow your money by at least 6% yearly just to keep up. Lynch also says that savings is a superpower. These days, people waste money on things they don't really need, which doesn't help them grow. Those who save smartly today will thrive tomorrow. Investing strategy number 2. Explore the 5 types of investments to become a smart investor. So, what are the best ways to invest? Peter Lynch shares 5 types of investments. 1. Savings account. This is the safest place to park your money because you can withdraw it anytime. But it's not a great investment option since it offers low returns, less than 3%, which can't keep up with 6% inflation. In other words, you are losing money over time. 2. Investing in collectibles. Think of items like vintage cars or antique paintings. These can be valuable, and some people will pay 10 times their original price. But there's a risk. You'll have to spend on security to protect them, and if they get damaged, you could face huge losses. 3. Real estate. Buying houses or apartments. This can be one of the best ways to build wealth, but you need to invest in the right property, at the right time, and with the right amount of money. For example, if you buy a house for 50 lakhs rupees with a down payment of 10 lakhs rupees. Pay the rest in installments over 10 years at 7% interest. After paying entire installments, you will get ownership of the property. And in addition, during this period property value could double to 1 crore rupees. But this only works for real estate, not luxury items. 4. Investing in bonds. Bonds are loans you give to a company or the government, and they pay you back with interest, around 8% to 10%. Bonds are safe but come with a catch. There's usually a lock-in period, meaning you can't touch the money for a while. 5. Investing in stocks. Stocks are Lynch's favorite way to invest. There are no entry barriers, and you don't need a ton of money to start. If you are unsure about picking stocks yourself, you can invest in mutual funds. However, mutual funds charge a fee for management, which lowers your overall returns. If you are young, stocks are a great way to aim for high returns and wealth creation. How to pick the right stocks, and why research is key. Choosing the right stocks is the most important if you want to make money. But don't worry, it's not rocket science. Peter Lynch says that many people make common mistakes like overbuying and selling too quickly, trying to time the market, investing without understanding the basics, lack of proper guidance. The key is to learn how to read a company's balance sheet. Here's what to look for. Loans. Check if the company has too much debt. Dividends. Does the company share its profits with shareholders? Annual sales growth. For big companies, more than 1,000 crore market cap, aim for 10% to 15% growth. For smaller companies, less than 1,000 crore market cap, it should be 20% to 25%. PE ratio. this is the price-to-earnings ratio. It is the ratio of share price of a stock to its earnings per share, EPS. P/E ratio is one of the most popular valuation metrics of stocks. It provides indication whether a stock at its current market price is expensive or cheap. Lastly, spend at least 15 to 30 minutes each day to keep up with the stock market and stay informed and updated. So, let's dive into how we can take these lessons and use them step by step in our everyday lives. Start early. If you take one thing away from this video, let it be this: start early. The sooner you start investing, the more time your money has to grow, giving you a huge advantage over those who wait. Know the business company. The journey to financial freedom begins with knowing the fundamentals of the company before investing. If you are confident, jump into the business. The future is bright for those who learn, invest, and grow. Remove noise. Forget about the daily noise of stock prices. They don't always tell the whole story. Focus on the businesses behind the stocks. Companies that grow and succeed will always bring their investors along for the ride. Don't time the market. Remember, the power of money is in your hands. With the magic of compounding, small investments today can turn into something truly significant tomorrow. Don't worry about timing the market. Stay invested, stay patient, and let the market work for you in the long run. Believe yourself. Whether you are a beginner or have some experience, the principles Lynch shares are timeless and easy to follow. Investing doesn't have to be complicated. And most importantly, don't be afraid of failure. Each loss is a stepping stone to greater success, and even the best investors make mistakes. The key is to learn from them and keep moving forward. Peter Lynch believed that anyone can become a successful investor, and his book shows us how. So why not start today? It is noticed that one of the key secrets to successful investing is mastering fundamental analysis, the method professionals use to evaluate stocks. If you are serious about taking your investing or trading to the next level and want to build a career in it, this knowledge is a game changer. If you are genuinely committed to learning and growing in this field, write down "I am serious" in the comments section. If I receive at least 500 comments and 100 serious subscribers, I will make a detailed, step-by-step tutorial on fundamental analysis, just for you. This will be an in-depth guide that covers exactly how professional traders make informed decisions. Also, let us know what topics or books you would like us to cover in the coming tutorials. See you next time. Namaskar.